Welcome to the Contrarian Capitalist podcast. I'm delighted to be joined today by first-time guest Rob Connors, aka the Crude Chronicles, over on Substack. Highly recommend you give Rob and the Chronicles, a follow. Rob, welcome to the Contrarian Capitalist.
Thanks, Rob. And there's two things you should know about everyone on Substack. Number one, you need to follow everyone whose first name is Robert. Okay. And the second thing is if the title of their Substack begins with two C's, you definitely need to follow them. So thanks for having me on. So you're a must follow. I'm a must follow. So hopefully everyone's following.
Oh, absolutely. Well, thanks for that early call to action. I do appreciate that. Rob,
Yeah.
just before we crack on, because obviously you're well known for, well, the Crude Chronicles, of course, we will dive into that. But just for those that might not know about you, a little bit more about your background within the industry.
Yeah, sure. So I had spent a cumulative total of about 15 years on the sell side for a small investment bank in the Baltimore area. And when you're coming out of college, you just want a job. But I was lucky enough to become a junior analyst for a very much a macro driven guy. And it was in the heart of the 2000 cycle. He was a early bull before a lot of the major shops. If many of your readers have ever read Jim Rogers' book, one of his mega charts was featured in that book as well. And so what he would always do is he'd send me to the Library of Congress and other places to reconstruct the histories of these companies, particularly these oil and gas companies. And so that's where it started. And what I'm known for is, again, the long-term histories. I always try to put current events within the perspective of the cycles and exactly try to answer where we are. Keeping in mind that history is merely one person's interpretations of past events. And so I've been doing this for coming up on 3 years on Substack as the interest grew. And so absolutely love what I'm doing.
Well, I do have to say your work and your charts are absolutely fantastic, and it is a pleasure to have you here today. I wanted to start with a 30,000 foot view of the oil market, and this will come across as a very layman's question because I think that many people are being fed this narrative of, well, we have this big glut happening, and that's bearish for oil, but actually, when you've got the IEA. I think it's the EIA, they're changing figures here and there, and they're missing barrels. There's so many directions that we can go. But I'll ask you the layman's question, Rob. What do you see happening with a 30,000 foot view within the oil market at the moment?
Yeah, sure. So the first place that I look at when the oil markets and when I was even beginning, my mentor at the time just said, go read The Prize. So I read The Prize by Daniel Yergin, which I'm sure many of your listeners have as well. And he says, start to notice the patterns that occur. And I started to notice a little bit and then started reading more books on the industry. And then you start to notice these patterns again occur over and over, different characteristics, or excuse me, different players, but the same sort of macro characteristics. So if I could just jump to the chart deck
Mhm.
that will be shared on, or that you can see here, is we're going to zoom all the way into, I think it's like slide 34 here. Okay. And I'm not going to read all of it because that will take an hour. But the gist of this is merely my interpretation of history
Mhm.
of the oil industry. And what it shows is the columns are each of the cycles that we have gone through since the industry began. There's been six of them. We're in the sixth one. We're about halfway through it. And the rows are the stages of each cycle. Okay. And I put them in rows so that you can see the parallels, right? So your first time through is read through this, go down, then go back up, down, then back up. That's how the history moves. But as you start to understand that, then maybe go through it horizontally so you can know the parallels. So the thing about this is stage one is typically war's end. New supply comes online, demand slows, and oil capitulates. And that's occurred ever since the industry was born. The Civil War ended. We had excessive monetary inflation. Oil was discovered. They produce at breakneck speeds in Pennsylvania. Demand did slow because of post-war recessions too, and oil capitulated also due to overproduction. And fast forward to this last cycle, we had the GFC, the global war on terror, essentially, came to pretty much a stalemate. We know about shales, and we finally oil capitulated actually twice. It made its absolute peak in '08, and then more people jump on board in 14. But stage two, you start to get instability in oil producing regions due to low prices. And that can be anything from, call it the Iran-Iraq wars in the 80s in the prior cycle to the Saudi-Yemen war, Saudi-Iran conflicts, but they've since reached a stalemate, as well as massive bankruptcies in the shale patch. Stage three, which is where we are, I think, wrapping up right now. It's a period of low capital spending and consolidation, right? And that's clearly evident. We first had the tier one, like the creme de la creme companies with great assets get acquired, and now you have the ones below that, like Coterra and Devon combining. Stage four, which is also happening, is debasement of the currency. That's clearly happening, silver and gold. But we've seen this before, is that prior to the World War One cycle, which was one of the strongest in history, all of the allies, in order to fund their wars, they abandoned the gold standard and just went to the printing presses. And then you have stage five, and this is where most people think the cycle begins, but it doesn't. Okay. This would be the equivalent of this would be like the '02 to '08 run. But the cycle had began actually in '98 and I could, you could even make a case in '94 it began in the prior cycle. But this is where new demand picks up. A lot of people point to AI. I think it probably could be a little bit different than that, but you also start to get global conflicts, and we clearly have that. And then stage six is what I call Hubert's peak, as peak supply, right? A lot of the talk today, which is starting to be pushed to the right, is, or at least to the left, however you want to term it, is on peak demand, but it may be more on peak supply, will be the argument in the future. So I clearly, now the thing about this I often get asked is, how often do you spend in stage one before moving to stage two? Because, we all want to time this for our portfolios, and it's not that easy, right? What I found, I wish it were that easy, but what I've always noticed is you never skip a stage. So, for example, you never go from stage two to stage four, and sometimes within your in stage three, there is still characteristics of stage four starting to blend in. So think of it more of like overlapping as you move through. Um, so that's where I think we are. And another way to say this sort of in the back half is this next slide on page 35. And I love this chart. I A couple years ago, I found a biography that Standard of New Jersey had commissioned in the 1920s. And they commissioned the history going back to Standard Oil and then after the breakup through the post World War One years. And the most fascinating part about this two-book series is that for the first time, they gave you Standard Oil Trust data, financial data. It's not GAAP, it's right. There's no FASB at the time. But if you actually think about it, back then it was probably mostly on a cash, non-accrual basis. So it's probably the purest form of accounting, even purer than now, if you think about it. But what I started to notice is the same pattern that's occurred for these companies as post Standard Oil and during Standard Oil, is that returns on equity, which is the best way to measure this over a long time series. You can argue about returns on capital employed. I do those metrics, or ROA, but these companies always gave you the equity sliver in their accounting. And the point of this is that they move up in three waves. Okay. And I call it doubt, a pullback, optimism, pullback, and then parabolic euphoria, right? And if you look at like something like a Nvidia, there's a three wave very apparent in that move over the last couple years. But it's not just oil and gas. A lot of, markets can move through this. Gold looked like this in the 70s, but the first wave is doubt. And people doubt the cycle, right? Now everyone's used to this bear market that happened from '08 to 2020. And so what happens in the doubt wave? You have terms like peak demand. You have companies not spending, right? They're not the higher price that we saw from 20 to 2022. They're not vastly increasing CapEx budgets. Or what we saw was energy's share of S&P earnings rise to 8%, but we only went to something like 5%, 4 or 5% of market cap of the S&P. So there's doubt in the cycle, and then there's a pullback, and we've been in a pullback for about 3 years. And the doubters say, "I told you so." And then there's an optimism wave, and you start to make higher highs and higher lows on ROEs, and then you get another pullback, and then you get the final wave where everyone's bought in. It pretty much looks like probably what mega tech looks like right now. It's a parabolic euphoria. It says we're going to spend this money, we're going to get higher returns. I think that period for tech was actually in 2025, and people are starting to doubt that right now. Whereas, energy's more in the beginning of that. So that's where I think, at least in, the bigger picture of the cycles we're at. I can, let you take over from there, but just sort of any questions on that?
Not at the moment. To be fair, I think that it does answer the bigger picture question, which I think a lot of people are going to have on their mind. I know that when we look at, for example, gold, just to bring that into the equation, that is the commodity that will move first. That normally sets the scene for everything. We know, I think everyone listening to this will know why gold is moving and the fundamentals at play there, so we don't need to repeat them. But the point on that is when gold is moving first, everything else normally catches up. And my understanding of oil is that it's normally the last commodity to catch up. But if gold is continuing to rise, then it will catch up. That's my understanding in a very layman's terms there, Rob.
Yeah, sort of like in a very basic term. And what's actually interesting is this is a chart, and I this was published January 6th, and I know we had the massive, this is before the massive rally in silver and before the crack, but I'm pretty sure the chart doesn't really change too much. Is that this was taught to me at I remember the same guy I was mentored on. We were sitting with a major PM at a major long only shop. And then this gentleman went on to work. He left that long only shop to work for a major hedge fund, which called the housing bubble. And he said in '07, watch silver to gold, it's broken down. Okay. And what you're looking at on the silver to gold ratio and the way it had explained it to me, and he still uses this,
Mm.
is that the silver to gold ratio is like a liquidity ratio, right? Um, and it's also a monetary, both metals tend to benefit from monetary debasement trade, but because silver has industrial applications, it's not only monetary debasement, but you're getting pickups in just global GDP as well, right? And that's worked even before all this talk of, EVs and AI and the silver input to it and yada, 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 is that every time silver to gold, this blue line here is broken out, oil tends to find a bottom, right? And so there's, but every time silver to gold hits resistance, like it did 2002, like it did after '07 when it started to sniff out the mortgage crisis, and then even over from the period 11 through 2020, oil really doesn't go anywhere. Okay. So silver to gold broke out decisively. But the thing about this is, yes, silver to gold needs to be rising, but gold has to be rising as well. Does that make sense? So
Mhm.
basically, silver has to
Yep.
be going up more than gold's going up because that's pro-inflationary, that's pro-GDP growth, that's pro-liquidity, and it tends to benefit oil. Now, we'll see here, oil's been a lot more sticky than what a lot of the barrel counters say. A lot of the barrel counters and sell side shops say we should be at 40 based on OECD inventories. And it's really racking their brain why we're not 20 bucks lower. Everyone I talk to runs a model, an oil price forecasting model, based upon counting barrels. And I don't doubt that, but as long as I've been doing this, like there's always counting barrels to me has always been a little bit of a dismal, murky science to me. And I'm not saying it doesn't work. It's just I like to approach it from a different perspective. So, and why is this? Why is this too? Is that why do like what you say there is that what you tend to notice here is that on slide 30, this is an 800-year chart. Okay. So it goes back to the Crusades on the left. Back to actually, it's a 10-year moving average. So that goes back to 1210. You can see the sources there. Is that at the end of the day, all commodities do move in unison. Okay. So, and why is that? Is that, and then you can even see here zoomed in since 1800, all commodities being fuels related products and power. That's the orange line. Basically, think of that as energy and oil.
Mhm.
You have metals in the blue, farm ag index, which is the oldest commodity in the world, right? You always have to have food and electricity, which people are terming, the commodity of the new decade, but it's really electricity is just another commodity transformed. But they all tend to move in unison. And why is that? If because they tend to, have different demand drivers, but underlying all those fundamentals is what you see here. And what you talk about, the gold bugs talk about on the deflationary trade is that all commodities move in unison due to monetary debasement or excessive printing of money.
Mhm.
And that's what we're seeing right now. And it's not new. It's really not new. The process had began in 2016. Is that what this shows here is the black thick line is an all commodities index. It's a 10-year smooth of the year-over-year change, right? It's just another way of doing 10-year CAGRs. And this green line is world M2 or world money supply expressed in US dollars. And there's a lot of history that you can take from this chart. And essentially what the blue text shows you is that in order to fund a war or a massive social spending program, governments will print money and they'll find any way to do it. Okay. For example, in during the Civil War, when oil was, came out of that commodity super cycle, they printed greenbacks. And then, like we said before, World War One, they abandoned the gold standard. And during World War Two, the where the Treasury went, the Fed followed, right? And the LBJ and I was just rewatching a documentary of the Vietnam War. Is that they Nixon suppressed the Fed, and there's Art Burns' famous speech about that era. And then we're seeing that again, is that in order to fund these global conflicts around the world, as well as social spending programs, which to me, the energy transition is nothing more than a social spending program reinvented, you have to print excessive amounts of money. And guess whose independence is being questioned once again? The Feds, right? So it's all pointing the same way. Now, why does this come about? Is because of the pink text, is that when you get these long periods of commodity disinflation and wage disinflation, you get the return of populism. And we're seeing that again. And after the Napoleonic Wars, you had the original populist, Jacksonian, Andrew Jackson. What did he do? He abolished the second central bank. And so then again in the 1890s, Williams Jennings Bryan, the Cross of Gold, and the Progressive Movement. What did he want to do? He wanted to monetize silver. Why? Because commodities were in deflation and he wanted inflation for the vast majority of the country. FDR was a populist under the New Deal. And because we've had this, they term it a K-shaped economy, but the top 1% with the S&P 500 going like this and real wages going like this
Mhm.
over the last decade, you got the rebirth of populism once again. If it wasn't Trump, it would have been, another character. Biden was a populist at the end of the day, too. So we have the return of populism. Doge was just a head fake. He was never going to pursue deflationary policies that Doge represented. And if anything, they're going to run it hot and they're going to suppress the Fed to do it.
I totally agree. I do think that running it hot is the option, the more palatable political option they've got on the table. So either that or the whole system breaks down. And I don't think whoever's in control, obviously President Trump at present, I don't think that anyone would want that on their watch. Oh, look, we just destroyed the economy. Where so I think running it hot is the most politically palatable solution that they have, which is a shame. But what I love about your charts here, Rob, I'm glad you brought up the 800-year-old one because I was going to ask you to bring that up anyway. But we can see clearly that this has happened before, and it looks like it's starting to happen again. And so I think this is where history is a fantastic thing to study, especially when it comes down to commodity cycles.
Yeah, for sure, for sure. So, the thing around barrel counting, or we have this massive oversupply. The interesting thing about it, what's happened as of late is, the problem with the oil markets, if we zoom in,
Mhm.
is that you could say it's excess supply, but there's really been no EM China demand, right? Over the last couple years. And if you look at all the forecasters, they're saying that it's going to be 200, 300,000 barrels a day through 2028, 2029. But the interesting thing too is that I think, especially coming out of this plenum, what we may actually see them start to support the consumer, right, rather than industry, which would be bullish commodities and bullish consumption overall. And the yen is one of the best, strongest currencies to date. So, would typically when, or excuse me, not the yen, the won, sorry. And typically when the won does appreciate specifically versus the dollar, oil tends to do well as well, do pretty good as well. So, you're seeing that in the charts. You're seeing weakness in the dollar. I think people are a little bit frustrated with the mega cap play and starting to wake up to the fact that overseas markets for the last, 2 years have been outperforming the S&P 500. You know what one of the best performing mega oil stocks has been the last 3 years?
Oof, off the top of my head, no, I wouldn't even want to hazard a guess and sound like a muppet. So no, you tell me.
PetroChina.
Really?
It makes no sense, does it?
No.
Even on a 1 year and year to date basis. So I never buy the narrative that, China demand is peaking. You have a purely China-centric oil company that's beating ExxonMobil.
Hmm.
And that's when the currency has been falling, and now you have a currency rising. So I don't know. Something to think about.
No, it definitely is. Thank you for bringing that to my attention. I just want to clarify. Uh, yeah, the one, if people aren't familiar, is all you might know it as the renminbi, i.e., it is the currency
Right.
of China. Just to clarify that for people that might not have understood that. So diving more into all then, and again, from what I read online and other people read online, we seems to be this narrative that we're being fed of this glut and demand is changing here and there as well. So from all your experiences, and I know you've gone through the historical factors here, but let's bring it to 2026. What does your research tell you, and what's your opinion on where we stand with regards to oil supply and demand at present?
Well, let me show you like oil supply demand, what are we trying to get to at the end of the day? We're trying to get to a price, right?
Mhm.
Okay. And let me show you my my different way of looking at the price equation that doesn't involve counting barrels. Okay.
Okay.
And so it's the marginal cost of supply. And what do I mean by that? Is that when, where do we have it here? Is that, yeah, I am on, where is it? Sorry, I'm trying to find it right now.
No, it's okay. It's probably a bit harsh for me to chuck random
Ah, here we go.
questions
Here
at
we go.
you with a
Perfect.
big slide deck.
Yeah, perfect. Here we go. Okay. So, on the I was never really good at counting barrels. And if I wanted to count barrels, supply versus demand, and an old director of research, told me a long time ago is that you need to be differentiated in your view. Because if you're looking at markets like the way everyone else is, you're just most of the time going to come up with the same answers as everyone else and you'll be consensus, right? What people value is a different view. Okay. Now you can be wrong, but you also have to tell them, why you're wrong and move on from there. So what I did is what you're looking at is the point of this chart is it's the marginal cost that determines oil prices. Okay. And I'll get into this in a minute, is that I went through over 70 oil plus companies, both past and present. And they do something awesome in the back of the filings is they give you, all the stuff associated with their reserve data. And they even tell you costs, how much it costs to produce those barrels of oil and gas, i.e. lifting costs. They tell you how much taxes they pay on it from their upstream operations. And they also, if you can do some basic math and understand how the reserve accounting works, tells you how much it costs them to find a new barrel, right? So think of it this way, in a very simplistic sense of oil and gas is number one, you got to go out and explore and find the barrel, right? That's
Mhm,
finding and development costs. And then from there, there's the lifting cost, getting it out of the ground, right? And then after you sell it, you got to pay a tax, right? Whether it's to the U.S. government or some Middle East oil sheik, right? And so that's if the marginal cost is rising, what it tells you is the floor for oil is rising as well. When you find a cheaper barrel and you get that continues to become the marginal cost and the marginal supply, prices are going to go down.
mhm,
Now, how well does that model work? Well, it has a R squared since 1979 of about 0.95. It's the strongest model versus oil prices I've ever seen. Okay. Stronger than supply and demand. If you look at like OECD, a lot of people look at OECD inventories versus oil price has a very strong R squared of about zero point 0.8, but the relationship only works until back to 2011. If you actually look during the entire 2000 cycle, the R squareds were not that high. Um, but this model has stood the test of time. So what does this also show you is that beginning in 2013 is that when oil shales started to step on the scene and more capital came into the space, the manufacturing mode took over and they were able to cut the marginal cost of supply by 2/3, right? And oil fell. But what we're starting to see is the marginal cost is starting to rise. And that's why
mhm,
the floor for oil is rising. And that's why I think we're not bouncing off 40, we're bouncing off 60 at the current moment. Okay. Now, if you
mhm,
take this oil price and what the summation of these bars on the bottom is finding and development costs, again, production costs and taxes, right? Um, versus oil price. Now, if you take this and let's just transform that green line of price into a monthly chart, is that you get a figure that looks like this. So this just takes oil price divided by the total cost of production, right? So that green line divided by the total summation of the bars. And you get a pretty tight window going back to January of 1980. Okay.
mhm,
And it's a range, but it can tells you when you're at the bottom of the range and the top of the range, right? Sort of like buy sell signals. And what tends to happen, and we actually tested the bottom of that range about minus 1.5 standard deviations or $60 a barrel, is that the marginal cost from here, according to this model, is about $80 a barrel, right? The midpoint. Now, the thing about this too is you can obviously pass from one extreme to another. You don't just stay in the middle, right? These are cyclicals. We go up and down, up and down. The long-term average is sort of meaningless. Now, what tends to happen when you're at the lower end of this range, when prices are low relative to the marginal cost of non-OPEC supply, you get two things. You get decreased non-OPEC supply, which we're starting to see. Number two, you got increased OPEC compliance, which we're actually seeing, right? And number three, you're starting to see increased demand. And we are actually seeing that now. People say, oh, it's just China stockpiling, but they are demanding more barrels. Okay.
Hmm.
At the end of the day, they are pulling in more barrels at the end of the day. Okay. And so for the barrel counting community who sort of, thwart this, this can still be a tool, right? In adding up your demand numbers and your supply numbers because it can tell you also when non-OPEC will start to respond to the downside, right? When they will
Hmm.
start to decreasing supply. And I think that's happening. And you're starting to see that. We got the classic Harold Ham indicator the other week, right? When Harold Ham usually cuts rigs out of the Bakken, oil has tended to find a bottom. And so we're starting to see that too, is that if you look at shales, these are components of that marginal cost of supply. What this chart shows you on the left, the stack bars, is this is Permian focused, right? Where the majority of supply growth has come from for the last decade. This is their finding and development costs. You can see here that when um, the shale boom began, it was $28, and by 2021, they cut it again by nearly two-thirds down to almost $12. We'll say by half, just to, excuse me, to make the figures easy. And then
Hmm.
over here on the right, these are LOEs, lease operating expenses. But if it's basically lifting costs, how much they spend to get this stuff out of the ground. And we were basically making these sort of long U-shaped recoveries. If nothing else, they've stopped falling. Okay. So the deflationary cycle in oil and marginal supply has stopped falling. And interesting thing about this chart is that, it also includes some of the legacy early companies in the shale patch. So I think what we're seeing right now, or a differentiated view, is that oil is low relative to the marginal cost of supply. So you're seeing oil producers start to respond, right? Particularly in the non-OPEC world of cutting capex and cutting production. And I think that's very apparent too, is that if you look at on this chart, this doesn't go back as far in history, but this is the Dallas Fed's energy survey. And they're very, very important because they have the Permian in their Fed district and they survey hundreds of E&P companies within their district and ask them, what are you going to do on capex next year? And we have two quarters in a row for the September December survey where more respondents are reporting capex cuts than increases, right? And the naysayers say to me, well, what about the productivity boom? Okay. And if you're not familiar with that, let me try to find it. The Let me see, let me find it here. The productivity boom is essentially that these shale operators have gotten so efficient with their capital that versus a decade ago to get I wonder if I really hope I have it. Actually, I don't think I have it in the slide deck. Um, but they've become so efficient in their capital spending at this point, but there are even signs that's starting to slow.
Hmm.
Okay. Now stepping back, I'll take this like and then we can talk about Saudi too, which is
Hmm.
very important to this equation. But why does, another important question is, okay, if your model is not reliant upon, tracking demand and supply, but tracking the marginal cost, right? Going back to this model right here, you have these bars going up and to the right here. Why do you think they go up and to the right? Why doesn't, the productivity cycle, the capital efficiency cycle continue? And I think that at the end of the day, the material constraint is geology. Okay, and I think we have been seeing that and starting to see that for the last couple of years. Is that this chart right here
Hmm.
shows well productivity growth versus development costs, right? Development costs being part of that finding and development costs. In fact, it's the biggest portion of finding and development. And the well productivity is a year-to-year growth, 3 year smooth. Okay. And development costs are in inflation adjusted numbers. And what you tend to find, and the way well productivity, there's many ways to measure this, but the way I measure it, the most consistent way to do it throughout history is take total production divided by total producing well count. Makes sense, right?
Hmm.
If you can double your production but keep your well count the same, right? Your number of holes in the ground, your productivity grew 2x, right? But if you double your production and have to double your well count, your productivity did not improve. Make sense?
Yeah.
So what you tend to find is that when well productivity slows, and you're even hearing signs of this, just Google EOG well results, you'll start to see some of it in some of the legacy fields as of late. But when it starts to slow, companies have to move into higher cost basins. And that's why real development costs begin to rise. And this is not new with shales. If you go back to the 1940s, the fields that were discovered in the late 1910 and early 1920s oil boom of Yates, East Texas, Seminole, and Cushing started to slow, and development costs started to rise. That was that first cycle shown there. And then in the 70s, well before the barrel counting world caught on with the OPEC embargoes, what you started to see was US peaked, and the most productive wells in OPEC were beginning to be nationalized, right? So productivity slowed. And then again in 98, my friend Arjun Murti tells a great story of he was with Goldman Sachs. And he was always wondering why his non-OPEC numbers were always surprising to the downside, that they had to rethink their way of thinking. Well, productivity growth started to slow. All right. And then what do we have to do? We had to move into higher cost basins like Canadian oil sands offshore. That was going to solve the world's oil problems. But then shales appeared on the scene. So if we get rid of the year-over-year smooth, 3 year smooth effect of this that this chart shows, here's what you get. Okay. This is just year over year. And I think peak productivity was in 2017, right? And
Hmm.
so we'll see. This is going to be a very, very interesting year for this chart, especially with lower prices and output not growing like it has been the last couple years. I think a lot of that had to do with duck counts, drilled uncompleted inventories that's been fully worked down as well. But the productivity growth rate is slowed, just like it has in either market. So, I'm pretty bullish. I think the floor for oil is higher. We're starting to see that. And I will, I'll just pause there.
Well, Rob, again, thank you. What I'm taking away from this is that we have a disparity in supply and demand. So demand seems to me like it's stronger than people think it is, which obviously, simple supply and demand helps. And then because of well productivity and, dare I say, problems in the Permian and so forth, then this is creating a very bullish picture. Question I want to ask is, given, I don't want to name any particular oil companies, but if well, we're sat here today and it's roughly WTI is roughly 65. We're recording this on Wednesday, the 18th of February. But do companies in total need a much higher oil price at present, or does that depend on the company, how big they are, what lands they've got? There's not really a question. I'm more sort of rambling, but yeah, what do companies need, I guess, price-wise at present, or is 65 okay for now, or should it be much higher for sustainability?
No, it seems, I think if you're more Permian pure play, you're hearing a little bit, the lowest cost suppliers are not quite ringing the alarm bell. They were ringing the alarm bell back in April, but they're not now. So
Mhm.
when you look at it like this, the shale boom happened primarily in the Bakken, and we have, Bakken producers such as Continental, cutting rigs. But you hear comments out of like Diamondback and Case over there, and everything is still okay at 60. And why is that? Is that because they're the lowest cost of supply in the non-OPEC world? Non-OPEC world, okay?
Mhm.
Um, Shoot, I could even make the case possibly in the entire world, if you include the different. but it gets complicated. But you're not seeing them scream the alarm bells, right? And so that's what you're looking at here is if I were to take this chart, um, excuse me, if I were to go back to my cost of supply and plot it by each integrated oil and E&P, right here, this chart, what you would find is that since the shale boom began, the top three producers have always been Permian focused producers. Okay. It was always Pioneer for the longest run and they were acquired. Now it's essentially Permian Resources and Diamondback. They have the lowest cost of supply. But then when you get above them, the diversified basins or say like, the single more concentrated basins in like say the Bakken, you're starting to hear that tune being sung a little bit, right?
Mhm.
It was quite interesting, like when you watch that all the big oil execs and going to the White House, Harold Hamm didn't look like a happy man.
No, no, that's an understatement, I think, to say the least. All we need is Jim Cramer to come in with calling the bottom on oil, and then we're probably off to the races as well. To be fair, Rob,
Yeah,
just
I'm waiting for the Economist cover.
yes, no,
It's
very
coming
true, Rob.
soon.
Yeah, once that there, then yeah, people that are in the know will know exactly what we're talking about. They're not exactly known for their timing on things over at The Economist. That being said, I just want to point out for people again on the audio form that are listening to this. So we're looking at page 36. I just want to point out just below that, so I think page 37, you've got here that the 2030 fair value estimate is likely to be around $110 a barrel, but that range could be anywhere between $80 and $135 a barrel. I appreciate there's people listening that are going to say, Rob's, just give me a price. What do I need to look out for? So that's what I can see on the charts in front of me.
Right, right. So, keep this in mind. The average is meaningless in the sense that
Mhm.
it's just something you pass through from going under to overvalued, right? If you take this more so marginal cost of supply framework, which I think is holds up just as well as, counting demand versus barrels and OECD inventories. So on that way, what this is showing you is that under current scenario, right, without now this can change if the cost of supply picture changes. Okay.
Mhm.
But as is right now, the for the last 10 years we've been reliant upon US shales and a little bit of Brazil growth for the incremental supply numbers. So, and the cost of supply there has been rising. So that's why this line's rising. Now, let's say they figure out, who knows, new technology advancements in Canadian oil sands, right? Which drastically cuts the marginal cost of supply. These numbers can change. As it
Mhm.
is right now, this is what it looks like, right? And this is another way to look at mid-cycle pricing. Okay. And you can look at also at mid-cycle pricing. Another way is, um, a lot of analysts will just take some sort of 5 or 10 year smooth average and hey, that's mid-cycle pricing, but you'll miss the peak on the way up and you'll stay bullish when oil is collapsing and you'll miss it on the way down too. Is that I put out a post the other day looking at what do companies need, the industry need to earn at least a 10% return on capital employed, which is the long-term average since 1911 for this industry, and they need $90 a barrel, right? And if you also look at that, what do the Saudi needs to balance budgets? They also need $90 a barrel, right? So what does all this mean is that the marginal cost of supply just across the entire world is moving up.
Rob, on that, and I'd be foolish not to. Number one, we'll talk about Saudi Arabia because you mentioned about them, but it'd be foolish not to bring in a short-term political picture into this. And regardless of people's political thoughts, there's midterms in the US, of course, towards the end of the year, and is it a fair thing to say that President Trump and the team and the administration there are going to want to go into that with energy prices, oil prices as low as possible. So I guess my question on that is, do you think there is likely something happening behind the scenes between the US and Saudi Arabia until after the midterms?
I actually do. I really, really do. Let's not forget that this Trump was he won the election with the mandate to beat inflation, right? And it is quite ironic that the first thing he does was actually quite inflationary with tariff controls. But at the end of the day, I think that he wanted to take the fight to China, and unlike a decade ago when they introduced tariffs and tech restrictions, China sort of took the punch, right? But almost 8 years later, China punched back this time. Said, okay, you want to tariff us, you're not getting your magnets and you're not getting your rare earths, right? And then every defense contractor in the world is like, whoa, whoa, like we'll have to shut down in weeks if we don't get our rare earths. And so what we saw at the end of last year was a pivot actually comes that, okay, like, China's playing nice now when really, nothing material, like, the US and Trump backed down, and then he pivoted to this, what they term this done road doctrine, right? And so, but to get back to your question, is that one of the first leaders he did meet with was MBS. Okay. And I think MBS knows he's smart. He knows right now, he saw that um, there's a 2 year window, I think, because every sitting president, unless you're pretty much in a wartime scenario, like Bush 2 was and like FDR was, you lose the midterms, you lose your majority. And his approval ratings are declining. Trump's approval ratings are declining. So it's actually not, it's pretty consensus thought he's going to lose the midterms, right? And then it sort of becomes what happens after that. It's a little bit of a lame duck presidency in the balance of the 2 years. So I think he's trying to just channel stuff as much as he can before those midterms, and MBS knows this, and that's why he got his weapons deal. Right
Mhm,
now, MBS says, "Tell you what, I'll give you cheap oil through the midterms, but it can only last so long." And why can it only last so long is Saudi Arabia is not in the same position financially and fiscally as it was in 2014 when it embarked on its first OPEC market share war. Okay. And why is that? And I talked about this on a post I did a couple days ago, is that if you look at Saudi Arabia and their material constraints, is that over here on the left, what this shows is that the blue line is their imports of goods and services, right? And that's been climbing steadily since 2016 when MBS effectively took power and started to talk about Vision 2030,
mhm,
right? Yes, they import a lot of equipment, a lot of services, a lot of capital goods to build up this infrastructure in the country. Now, his main export to cover that is oil exports, right? And so right now he's running a current account deficit, right? And every current account deficit needs to be funded by a capital account surplus, right? Sort of economics 101, go back to
mhm,
there. Every time he runs a current account surplus, you actually see these sort of things like the Aramco IPO happen in 2019. We got a secondary offering in June of 2024. Saudi Arabia, you can go look this up on the news streams, is one of the biggest borrowers of foreign country debt. And so I think really what's happened is that he said, I'm going to give you some cheap oil, but it can't last that long. And why can't it last that long is that you got to keep in mind Saudi Arabia keeps a peg to the dollar.
mhm,
So to keep 20 Vision 30 going, and especially with the dollar falling, the price of imports is rising in Rials. Okay? Because the Rial is essentially a dollar currency and it's been falling lately. And in order to keep 20 Vision 30 going on, which is largely dependent upon imports of goods, services, and capital equipment, the price of imports is going to keep rising and be inflationary. So what does that mean is that the break-even oil price because of this is no longer, call it 50, $60, but it's 90. It's closer to 90 to balance the budget. Okay. Now, okay, well, if they kept the OPEC market share war going on from 2014 to 16. Why can't they do it again? Well, over here on the right is they were in a much more formidable position to keep up that market share war than they are today. And if you look at their total reserve assets at the Saudi Central Bank, right? So let's just
Mhm.
say all creditors to Saudi call in their debt and say, I want to get paid now. They could essentially empty the central bank and pay it off instantly. But in 2014, they had over, 2.775 trillion. It's a little under, I think the exchange rate, the peg is 3.75. So we'll just say, 900 billion or so. My math's definitely off. But they had massive, massive amounts of reserves and pretty much zero public debt. Zero. I mean, look at the orange bars versus the blue bars. But right now they're pretty much equivalent. So I don't think that they can keep this low price environment going for much longer, right? And in order to the chart on the left, it's basic simple economics. If you want to outgrow your debt, your nominal GDP needs to be growing faster than your cost of capital or the interest rate expense on your debt. And that's not happening. You can see here the blue dotted line is nominal GDP growth. That pretty much looks like an oil price year over year growth, right? And their financing costs are relatively cheap, 3.8%. But at oil prices where they are, the debt load is going to continue to pile up relative to nominal GDP.
To me,
So their
what
break
this
at the
all,
end of the day,
yeah.
this all gets down to their break evens are about $90.
To me, from what you've explained, and thank you again for referencing the charts and the graphs, to me, it just all sounds like a completely coiled spring that at some point this has just got to go higher, given everything you've said, all the dynamics that the oil price, barring, new technology coming on board that makes the supply cost significantly cheaper. This to me sounds like it's, at some point it has to go significantly higher, the oil price in general.
Yeah, yeah, I think, at least mid-cycle pricing is 20, $25 higher than here than current levels. So,
Yeah, that's just under 50%. If my maths is correct, it's about 40% up from where I think we are at the time of recording. But Robert, we'll finish off with this. Obviously, it's the contrarian capitalist. People like to look for contrarian opportunities, and I think in the general scheme of things, oil is very unloved amongst the masses at the moment. So I'm not going to ask you to name any particular companies, and this is just for educational purposes only. But I know that in your chart deck as well, when we're talking about capex and things, that you also talk about how strong a lot of balance sheets are at the moment in oil companies. So if people wanted to pay more attention to that in terms of potentially investing in oil companies, again, you don't have to name any companies if you don't want to, but what sort of things should people be looking at, and what do the balance sheets tell us at the moment in terms of how potentially strong oil companies are?
yeah, I mean, this chart on page 18 is looks at net debt to capital, right? Um, and back to 1914, and you can see we went from net debt to cap of 15% and doubled it to 30%. While at the sector same time, the cost of capital and sector betas went way up, right? But we've essentially unwound the entire shale area era debt fuel binge that's happened. And, they had to leverage the balance sheet because you can see right here, this is their spending rates. This is E&P's CapEx divided by EBITDA in the blue bars and CapEx divided by DD&A in the blue line. Or excuse me, the bars, the orange bars is CapEx to EBITDA and the blue line is CapEx to DD&A. What does this mean? Is CapEx relative to EBITDA just tells you, are you outspending your cash flows? That's it. Okay. When you're outspending your cash flows, then you got to go to external sources of financing, whether it be debt or equity markets. They went to pretty much both. And then CapEx to DD&A is another metric, but think of this as, are you building more than what you're using up? CapEx is building, DD&A is what you're using up. And they went to all-time highs, right? 4 times CapEx to DD&A, and they levered up to do it to build out the shale boom. And so why was that? It was painted under, it's sort of like AI and data centers now is painted under this, nationalistic umbrella of energy independence and winning the energy race, winning the AI race versus China. Sound familiar? But the reason was is they were incentivized to do so, right? Is that right here, and this will get to my point, just stick with me of how to
Mhm.
choose, energy and oil stocks, is that what this shows is E&Ps, not a lot of people do this, and we do it here because I think it tells you is if you show me the incentives, I'll show you the outcome. That's it. Okay. But Buffett's known for saying that. But what we dug through was all the annual proxies, and they give you a breakdown on how executives get paid annual bonuses and performance share units and what have you. And if you go back a decade, is that over 30% of annual bonus weightings was for increasing reserves in production. They're incentivized to drill. Okay, and that's exactly what you got. Now it's less than 5%. Okay. And then what's offset that is they've been paid to become more efficient with their capital, right?
Mhm.
And some of them have even emphasized value creation metrics. So what does that mean? That's things like returns on capital employed, ROIC, ROE, anything that measures profit relative to some sort of capital spending or asset base or capital employed, what have you. It's the efficiency of creating profits. And so, what I would tell you how to pick your stocks is focus on the ones where the incentives are in line with yours. Okay. And also focus on the stocks where they pay their executives relative to a larger portion of relative to beating companies even outside the oil sector. A common problem in this sector is, a big portion of executive pay is tied to performance share units, right? And the way that works is it's about 45%. The way that works is that I'm going to give you a metric, and if you beat, this metric, then you get incremental more shares, right? Your compensation goes up. Well, a lot of in the oil sector only benchmark versus their sector. And when you're in a period of underperformance, which oil has been for the most part, it's like you only have to beat the slow kid, you know? If the average like is a 10-minute mile, I only got to run 8, right? That's not that fast, okay? The S&P 500 has been running a 5.5-minute mile for the last decade. Look at companies that benchmark their executives to the S&P 500 as well, and meaningfully benchmark it, because they're going to put in capital allocation strategies to compete with that because their benchmarks are higher. Does that make sense? So
Mhm.
when you come down to it, I did a post on it. You're going to come down to, some of the larger cap E&Ps that are left, as well as integrated oils. You're going to come down to answer that question, you're going to come to companies like ExxonMobil, Chevron, Diamondback, ConocoPhillips. Those are the leaders on those metrics. The companies that do not do that, that still emphasize creating ESG mandates and what have you, you're going to come up with a list of European oils. And there's a reason they trade at a massive discount to the oils, to the US oils. So hopefully that's a long-winded answer of answering your question is just simply follow the incentive structures and you'll get your outcome.
Well, again, I just want to say thank you on that, Rob, because
Yep.
that's helped me to put a few things into perspective as well. You've just highlighted some things that I wasn't aware of, but you've also mentioned a couple of key companies that I had in my head, and I think I've mentioned before on the channel for those that might not be as familiar with oil as people that are listening are familiar with gold and silver, for example. So thank you for that. Uh, I guess I will ask this just before we wrap up. Is there anything I haven't asked you that you would like to bring to the listeners' attention before we sign off?
Um, No, I think, I could go on for a long time. I think refining is, set up pretty darn well here. The
Mm.
shutdown, we've had records amounts of shutdown of capacity since 2020. That's why you're seeing refining, despite manufacturing PMIs pretty much been weak for the last 3 years. We're starting to see a pickup as of late, but distillate crack spreads have been really, really good over that period, and it's keeping the entire refining sector afloat. Is that if we are in sort of like an emerging market, international reflation environment, manufacturing reflation environment, that's going to do well for distillates. That's going to do well for refining as well. So, that's another sector to pay attention to. Before I get too bulled up on oil field services, I do want to see the consolidation that we've seen among their customer sets. The thing about when you've cut the number of E&Ps in half, like we have in the last 10 years, but the number of oil field services is relatively flat, the bargaining power goes with E&Ps, and they're going to continue to push on pricing, I think. So there are some subsectors, some, idiosyncratic stories within that, but for the most part, would still stay more so like on the oily side, as well as on the refining side.
Well, perfect. I think that's a great place to finish up. And there's a lot of things for people to take away, I think, from today's podcast, today's video as well. I always like to give people the opportunity to say how they can be found. So please do share that, and I will link to that in the show notes as well.
Yeah, sure. So you can find me on the app formerly known as Twitter, now X. Just search for Crude Chronicle. If you really want to find me, you can just Google Crude Chronicles Substack or go to thecrudechronicles.substack.com. My email is here as well. Feel free to reach out, and love to have you guys along for the ride.
Well, fantastic stuff, Rob. It's been an absolute pleasure, and thank you very much for your time. And look forward to catching up again later on in the year.
Yeah, sure thing, man.